Morris, I want to talk about some of these individual picks, but why don't you start us off by giving your broader perspective on the market? We've been talking about the Fed. We've been talking about inflation. We've been talking about geopolitical risks. What's your outlook right now?
Okay. Well, we just wrote a letter to our limited partners and to our investors. And we basically said there were two factors adversely affecting the market. The first one, I think, is pretty much past. I call that indigestion, the fact that so much paper was put into the market last year. And the second one, I'm just going to use under the word uncertainty, fear of the Fed, the geopolitical environment, things that we can't. The first one you can sort of quantify, the rest of them you can't. And our approach has been stay invested in quality, but build some liquidity, which we have, and take advantage of opportunity when you think that opportunity is there.
Well, so speaking of opportunity, we just heard Disney's earnings last week. I know Disney's one of your top picks, along with Amazon. Both of those stocks up this morning. What are you seeing in terms of the opportunity versus valuation equation there?
Well, the way we look at it, we think Disney's a cheap stock. When you look at the assets, the real estate, the library, the fact that that gives it a tremendous base of, in anything like a normal economy, recurring income. And the fact that we appear to be, subject to another variant, we appear to be moving into a more normal economy, domestically first, eventually worldwide. So you've got a company with great franchises that's been investing and is continuing to invest in the thing that sets it apart, which is high quality entertainment. And I think its decision to emphasize streaming within the context of offering a wide range of entertainment products is right on. So we really like it, and we were really impressed with the quarter.
Morris, good morning. How do you define quality in this market? I think when you were on with us at the very end of January, you were saying, hey, I want to stay away from anything that's not profitable right now. But since then, we've seen quite a rebound in some stocks that have pretty strong growth, pretty strong net revenue retention, but are younger companies. Are you still defining quality in the same way?
Yes. Look, we love younger companies. We want them to be making money, especially in an environment where financial accommodation is probably going to be more disciplined, and where we run the risk of a discontinuity. Hopefully, we won't have it, but we're right in the middle of one of those periods right now with respect to Russia and the Ukraine. So when we take those two factors into account, we have some young companies. We were always doing that. That's why we were in Amazon for, fortunately, a long time, and Apple for a very long time. We still are. But we want to see cash flow. If we don't see cash flow, we're going to be very impatient.